How do institutions control paper commodity futures markets? Imagine a giant game of chess played with money and contracts instead of pieces. That's how big institutions influence paper commodity futures markets every day. These markets are where traders buy and sell contracts that promise to deliver commodities like oil, wheat, or gold in the future. But they don't always want the physical goods. Instead, they trade what are called paper contracts, which are just financial claims. Institutions like hedge funds, large banks, pension funds, and asset managers are the main players here. They control these markets mainly because they trade in huge volumes. When they buy or sell thousands of futures contracts at once, they can push prices up or down. Their trades can create quick price moves and affect the overall market trend. This is because their large size makes their actions more noticeable than individual traders. Another way they control the market is through index funds that track baskets of futures contracts. These funds buy or sell large amounts of contracts to mirror a commodity index. When they do, they can cause noticeable shifts in prices, especially around daily settlement times when contracts are finalized. This can lead to temporary price swings that may not reflect actual supply and demand. Institutions also use swap agreements with financial firms. These swaps let them gain exposure to commodities without directly trading futures contracts. They agree to exchange cash flows based on the price of a commodity. These large positions can influence the market by shifting how prices behave, sometimes increasing volatility, or changing the usual relationship between spot prices and futures prices. Hedgers are those who produce or use commodities and want to lock in prices to avoid risk. Speculators, including many institutions, trade to profit from price changes. When institutions act as speculators, their trading can cause prices to move in the short term, sometimes disconnecting futures prices from the actual physical supply. Market liquidity is also affected by institutional activity. When they trade actively, they make it easier for others to buy or sell contracts. But if they suddenly pull back, liquidity can dry up, making prices jump or fall sharply. This can lead to more unpredictable markets and sudden price swings. Knowing how institutions control paper commodity futures markets helps investors understand price trends better. Large flows from these players can create momentum, boost volatility, and sometimes cause distortions. When they are active, technical analysis and momentum strategies may work better. When they are less active, fundamental factors like supply and demand become more important. In short, institutions shape these markets through their huge trading volumes, use of index funds and swaps, and their role as speculators. Their actions influence prices, liquidity, and volatility, which are key factors for anyone involved in trading or investing in commodity futures.